I think that's definitely something I learned over the years. I guess probably the right word is maturity. I definitely was always a shiny object guy and always like thinking of, oh, here's a new strategy. We could try this. And it's like, maybe if I just focus on the strategies I have right now and actually just do it, I'll probably be more successful than coming up with a new idea every 25 days.
Welcome to the Deal Flow podcast. Joining us today is Jon Siegel, a partner and chief investment officer at RailField Partners, an experienced multifamily investment and asset management firm. Jon is a distinguished expert in the multifamily real estate sector with over 3 decades of experience and a strong track record in the core plus multifamily growth markets. Jon has a demonstrated expertise in strategy, acquisitions, and financing throughout his career. He's worked in several prominent multifamily investment firms, including J.S. Watkins Partners, where he advised clients on more than $25 billion worth of transactions. At Fannie Mae, Jon negotiated and closed capital market transactions involving property pools ranging from $50 million to over $1 billion. Jon offers valuable advice for long-term success in multifamily investing. Jon, thank you so much for joining us. And what an amazing career you've had so far.
Well, thanks for having me, and it just makes me sound old, but I guess I am now. So,
oh well, you're seasoned, you're seasoned and experienced, right? That's the correct way. So having provided you that kind of bio there, if you could just in your own words introduce yourself, share a little bit about your background and your current role here at RailField Partners.
Yeah, sure. So I always say now I've been in commercial real estate, mostly multifamily, for longer than I care to admit. So I sort of fell into it originally, and the first place that I worked at a business school was a company called NHP, which was actually the largest owner of apartments in the country in the time. This was in the 90s. And I like to say, and I don't know if anybody from there will be listening, it was so poorly run that they allowed a guy that was like 25 to do all these deals with little to no supervision. So I guess there's a saying, make your mistake with other people's money. So that allowed me to do that, I guess I would say. But it was a great experience. We did a lot of deals. The company actually was owned by the endowment of Harvard University, so they had a lot of money, and eventually went public. And so I did acquisitions of companies. We bought a couple of companies, and I did a lot of property acquisitions. And then that company actually became what's called Aimco, which now I think has changed its name since, but it sort of merged, got sold, and not a good time for the acquisitions guy when the company gets acquired. And so that's when I switched from being a principal to a lender, and I went to Fannie Mae and did what they call the structured transactions. I actually did 2 things at Fannie: the structured transactions, which are negotiated deals with REITs or any big entity that's borrowing money from Fannie. Instead of doing like a one-off loan where you do it with your local lender, those were deals that somebody from Fannie Mae did the deal on that. That was my job. And the biggest one we did was, I think, $8 billion. And, but it's Fannie Mae's money. So there's a lot of zeros there that, people are like, well, that's a big deal. I was like, well, it's not like I got a piece of it, but good experience being a lender, but always had sort of the entrepreneurial itch. And I had done, while I worked in Fannie, had done some deals on the side, some smaller deals, bought some single family rentals, some smaller multifamily stuff. And everybody at Fannie knew about it. And actually one of my colleagues at Fannie said to me one day, like, hey, I heard what you're doing with this stuff. I'd like to do that too. Maybe we could do one together. And we started talking about it. And then one day after some, horrible meeting at Fannie, write another memo and have another committee meeting or whatever. We're like, we got to do something else. We got to get out of here. And so that was the genesis of leaving Fannie. And we picked the wrong time, really, which was during the great financial crisis. But we had a hard time sort of getting started, buying deals, but everybody that we had met along the way were like, hey, we'd love to have you do some advisory work for us. And so we ended up doing a ton of advisory work, which kept the lights on, for a while, until actually, my other partner, who is a guy by the name of Ken Bacon, who ran multifamily at Fannie Mae. So he was our boss at Fannie Mae, and he left, and he came to us one day and said, hey, I might be able to get some money. And I said, Ken's kind of a big shot. He's not going to write a memo or do a spreadsheet or something like that. And so somebody came to him and said, hey, I might have some money to do some multifamily. if you want to start an investment firm, he goes, it sounds like it sounds like a lot of work. And they're like, we have the money. And so he came to us and said, you guys want to do it. So that was the start of RailField, which was started now, hard to believe, 11 years ago. And since then, we team up with primarily institutional capital, and some family office capital as well. And by multifamily, we're in 11 markets in the Mid-Atlantic, Southeast, and Texas. And I do all the acquisitions, dispositions, financing. I'm sort of a transactional finance kind of guy. So that's a rambling introduction of me.
No, that was great. What a great progression in the career, and to go from the lending side to the principal side, and a lot of great background there. Yeah. What do you think? What do you think in your current role you really lean into? What's sort of applicable from your experience that you kind of take into the current role that you're in?
Yeah, it's interesting because obviously I was a principal, then I was a lender, now I'm a principal again, and when we do financing deals, and so first of all, everybody calls, if all the people I knew in the lending space, I could give them deals. I'm always like, I don't have that many deals. I'd love to give everybody a deal. But we work primarily with one or two lenders that I had long relationships with. But I always tell people like, we can be your best client or your worst client. Like I know enough to know that, what you're asking me is either what you really need or you're asking me for something that you don't really need. And so, I think it works well with the lenders. I think they like working with us because, they'll come back to us and say, we need this. And I was like, I understand why you need that. I don't want to do it, but I understand. But it also gives us a lot of, it gives us a lot of credibility because a lot of, I'm always surprised a lot of people don't really know that much about the financing side, people on the principal side. And so it gives us credibility, but it also, allows us to do some deals. Financing in multifamily is fairly straightforward, but we've been able to get some pretty good deals just because we sort of know what to ask for, and not in like a pound the table, crazy negotiation way, but just sort of like, hey, can we do this? Can we do that? Can we do this? And that's given us some better deals. We had a deal once where we were going to sell the property, and we were thinking maybe of having somebody assume the loan. And so we gave them the broker, a bunch of information. We gave them the loan documents, and and they came back to us and said, man, we have done deals with, we sold deals for everybody, Blackstone, whatever. You guys' loan documents are the best loan documents. And I was like, yeah, well, my partner, Todd, he was the general counsel, in the general counsel's office at Fannie. He wrote the loan documents at Fannie. So we know what to ask for. We know how to get it. So it's all sort of additive, I guess. I think it helped me as a lender that I had been a principal before, because everybody when I was a lender had only been a lender. And it's like, no, I've been on the other side of the table. So it's good to sort of, see it from both sides. I think it helps you to sort of know where you might be able to add or where something's just impossible. And people say, oh, this is a great deal. You can do this. It's like, nah, you can't do that.
Right.
Yeah, we're not going to do that. So
you sort of have the inside baseball, you kind of know the inside of how things work, how the sausage is made. So, which sausage to eat and which not to eat. Yeah.
Right. Exactly.
Yeah.
So, it's great. Helpful. And that's also probably a byproduct also of being around for a long time, but
sure. But, you've seen a thing or two, so to speak. Cool. And I guess what made you initially, when you were starting RailField, decide on multifamily specifically versus the other commercial real estate asset classes?
Yeah. I mean, we had been, I'd been primarily in multifamily, I'd done some other stuff, but primarily in multifamily during my career. And when we were at Fannie, we were Fannie Mae multifamily, and we did multifamily. And so, I think there have been opportunities, and there are opportunities in other asset classes, but, I think we just sort of leaned into, this is what we know. I used to always say, like, I don't know a lot about a lot, but I know a lot about this. And so like, it's sort of lead with your strength and just go into what, to what you know. And also, you get a better reception. Anybody that's on the principal side knows that, you're always looking for two things, deals and money. And when you're looking for, especially, when you're looking for deals, you might know more people who are going to get you deals. And when you're looking for money, you have a lot more credibility. People seem much more receptive to talking to us about, hey, well, we're interested in doing deals with you. If you're doing multifamily, if I came to them and said, hey, I got this great deal on a grocery anchored retail center, they'd be like, yeah, it sounds like a pretty good deal, but what do you know about that?
Yeah. It's always a struggle. I think the value prop for folks that are doing multi-asset or like multi-strategy type products, because it's like, are you a capital allocator? Are you an owner operator? Like where's the edge, right, that you're bringing to the table? If you try to do everything for everyone and you're just trying to aggregate and connect capital to deals, it's not really a value add. It seems.
Yeah. And as I say, we just got such a better reception when we were talking about it. And even now, I'm like, some of the stuff like around the office space, I was like, I would consider buying an office property at, 5 cents on the dollar, but I'm not sure, so I'd be like, well, yeah, you just did, 30 multifamily deals. Why would I give you money to buy an office building? So
yes, sometimes it's about reducing that friction and just like going where the flow is, not necessarily trying to create something brand new. But sometimes as a deal professional, as you know, it's those shiny objects. If you can buy, I want to buy an office building at the land value, like, I can make money, but it's going to take me 10 times as much time and effort to get that deal done versus just a straight down the fairway core plus deal for you guys, I'm sure.
Yeah. And I think that's definitely something I learned over the years. I guess probably the right word is maturity. I definitely was always a shiny object guy and always like thinking about, here's a new strategy. We could try this. And it's like, maybe if I just focus on the strategies I have right now and actually just do it, I'll probably be more successful than coming up with a new idea every 25 days.
It's helpful to have partners sometimes that, can be like, hey, listen, no, we just agreed we're going to do this a week ago. We can't just be going back and forth and treading water here. So I guess if we could just go to kind of today's market a little bit, I'd love to talk a little bit about what you're seeing today. Obviously, the market's changed significantly over the last, I think maybe it'd be great to give a 5-year picture, because it's kind of like Jekyll and Hyde a little bit from where we were 5 years ago or 4 years ago. We go through COVID, we have this run up in asset values, the decrease in interest rates, and then the market kind of, fell off a cliff a little bit, and now we're in a little bit of a limbo. So love to hear, what you're seeing, through that period. How did you guys fare? And then today, what are you seeing right now so far as the market?
Yeah, there's a lot to talk about. It was, we were in, and again, I guess if you've been around for a while, we were in a bit of a bubble, I guess, at when we hit 2020. It was interesting because, leading up, say in 2018, 2017, we were probably in sort of a pretty good spot in terms of a cycle, and, deals were starting to pencil and it kind of worked. Things felt like they were getting a little frothy before COVID happened, but I guess, the cheap money around COVID just really turbocharged things. And, I think you just had people that, again, I keep talking about age. I don't know why I'm talking about that today. I don't normally talk about that very much, but you have a lot of people, just by straight math would be like the cycle, we had the great financial crisis, things got better. And in say 2012, 2013, things started to really start to be a little bit back to normal. And that's when people probably started hiring a lot of people. And so a lot of the people who've been in the business, even, go to 2020 or whatever, you've been doing it for 7 or 8 years. I mean, you have some experience, but they have never seen another cycle. And a lot of the people in the business, even if you got into it maybe during the great financial, you just hadn't seen the run up to another cycle. And I think so a lot of people had only seen good times and kind of felt like it, it only goes up. And so
housing only goes up. That's the line, right? Yeah.
Right. It probably does, but just not in a linear fashion.
Right. A long enough time scale. Yeah.
Right. I do say that time in real estate, time will heal all wounds. If you have a long enough timeline, you'll probably end up doing okay. But I just remember that it was probably in 2020, 2021, talking to one of the brokers, one of the bigger brokers down in Texas. And he said, 90% of the deals we're doing now have these debt fund loans. Like nobody's doing, because I'd be like, I just can't make the deal pencil. I just don't understand. He goes, yeah, because everybody's doing these debt fund loans. And so, like at the time, they're great. It's a great deal. And why would you not do it? But money was cheap. And I think you had a lot of people who didn't have the long view. And, and we did it, you could buy a property. Like we bought a property in 2016, 2017. And in 2020, 2021, we sold it and we did great because cap rates went down. I said cap rate compression made me look like a genius. And, you were selling, and you're like, man, I can make a ton of money doing this. And so people started loading up on those. And like any cycle and any, I don't know, a bubble or whatever you want to call it, it got away from us. And look, we never did as RailField. And, I guess we get blamed for it if we did it wrong. So I guess we'll take credit for doing it right, which is, we never did a debt fund loan. And, not that it was wrong to do one, and people will do fine with them, I'm sure, but we never did variable rate. We did variable rate finance. We paid off all our variable rate loans. I think in 2021 was the last one we refied out of. So we didn't have variable rate exposure when rates started going up because we saw that, it wasn't sustainable. When we model a property out, we always model out the forward yield curve, and you could see that it just had to go up because it was so low. And so we got out of it, so that made us look smarter than we probably are. But I think when money was cheap, people overpaid, and we did. We bought. I bought a property in a 3.5 cap also, so I'm not without going along with everything else. But once rates went up, obviously everything changed and everything stopped. And I think the biggest thing that is impacted, obviously, there are a lot of people, I think, in a couple of camps. One, people who did deals during the run up, who have deals that are on a variable rate financing, and they have a problem with that, or their loan's going to mature and the price has gone down or whatever. There's certainly some people that are in trouble or trying to keep the ball in the air for as long as possible. There's certainly some of that out there. But then there's also a lot of people who just went on the sidelines when that happened because they just didn't know what to make of it, which is not unwise in its own way as well. And I think the two things that I think of and sort of the way we operate here is what we need is some sort of stability. It's not, I'm not a big believer, like everything I read now, and I'm sort of jumping all around here right now, but everything I read now is, the Fed's going to cut rates, which presumably they are going to do a cut at the next meeting. But, people are like, the Fed's going to cut rates. I was like, yeah, the Fed's, and they probably should. But when they cut rates 25 basis points, if you got a variable rate loan and the index was at 5 basis points and now it's at 530 basis points, if they cut rates by 25 basis points, it's not going to solve all your problems. I mean, it's moving in the right direction, right? It's moving in the right direction. And so, where rates are today is probably indicative of where they have been historically a lot. And wherever it is, it's just, to a certain extent, acquisitions are a math problem, and you just need to be able to figure out a way to make money where they are today. Like it's not going back to the way it was in 2021. It's not going to be, probably a year from now you'll call me and be like, look, silver's at 5 basis points, but it's probably not going back to 5 basis points, and the Treasury's not going down to 1.5%. It's it'll drip down and it'll settle in a place, and that's the way the business works. And you have to just figure out a way to do things. And so we've stayed busy. We've done acquisitions every year. We didn't go on the sidelines. I'm not a big believer of being on the sidelines because I think the biggest thing is you'll never know when the market changes if you're not in the market at all times. And we found there's a lot of banging your head against the wall now, but we've done deals of different types. We bought a new construction. We bought a value add. There are deals that work now, but you just have to sort of grind out, look at a lot of them, and just be realistic about it. And you're probably not you can't size out a home run on every deal, but there are deals that work now. So we're still out there doing deals. And
yeah, I'd love to if to the extent that you can, maybe speak a little bit to your investment, approach and strategy. I know you guys are focused on that median income, rent, tenant. So maybe you could speak a little bit about that investment strategy beyond just multifamily, kind of what you target, and then maybe show that through an example deal that maybe you've done this year or that's top of mind, perhaps.
Yeah, sure. So we kind of operate. I mean, our stated strategy is that we focus on multifamily that serves residents that make between 60 and 120% of area median income. And area median income is a defined term by HUD. And that sounds sort of affordable, but it's not really like, and so at the 60% end, that is an affordable deal. That might be a tax credit or, what we call naturally occurring affordable housing. If you go sort of then across the spectrum and you go to say 80 to 100% of AMI, value add properties, workforce housing, pretty straightforward Class B multifamily. And when you get to the 120% of area median income, then you're talking about, what we would call probably core plus, maybe not your, 30-story AAA property on Main and Main, but, could be new construction depending on where it is. And so, but that's the deepest part of the market, right? I mean, there are certainly people that focus on more affordable and people that focus on, only Class A. But we think the deepest part of the renter market is there. And when we look at deals, we operate sort of, as I say, with three pockets, I guess we call it, where we have a fund that focuses on housing preservation, it's called, and that's more focused at the 60% of area median income, and that's with a big bank that is the sole LP on that, and they're trying to do a sort of a keep housing affordable, social impact kind of angle on that, and then we have a fund that is what we do most of our business with, but that is a value add fund. And that buys, again, that's sort of in the middle of that 60 to 120% range. We've bought without anything from a, property built in the 70s to, a newer property. And value add for these investors, and these are pension fund investors primarily. And they define value add. It's interesting because we were one time trying to define it. And I kept talking about, we upgrade the kitchens, whatever. They're like, we don't care what you do to the property. It's a return metric. If you can get us that, low to mid teens IRR, we don't really care how you get it. Just get that. That's value add to us. We don't really care. That's just a metric. And then at the other end is what we'd call, core plus. And we have a relationship with a couple of families that have been investing together for, a couple of decades. And we buy and own with them, primarily we'll buy new construction, put a long-term loan on it, hold it for 10 years. And then, when the loan comes due to sell it, we actually just sold 2 of the properties in the last couple of months, and we're in the process of buying some replacement properties for them. So we're sort of in those 3 parts of the market, which is most of the market, and we're generally looking at any given time to fill those orders, if you will. And sometimes that the people at the 120% end are not interested in doing anything, and so we're focusing on the other end, and sometimes the other people are not. And so it sort of depends on where we are. And then again, obviously the market drives a lot of that on, there's not a lot of what I would call straightforward value add deals right now, where you're going to go buy the property and fix up the kitchens and the bathrooms and turn around and sell and make a big profit. There's not a lot of those make a ton of sense right now. But we do think there's an opportunity on the new construction side with, cap rates are higher. There are people that have construction loans that they have to pay off. And they're merchant builders. You're not going to get like a great bargain always, but you can get a solid buy there. We have a property that we're buying right now. We did buy in that space. We bought a what I would call a distressed deal last year. Just a couple of examples. We bought this property was recently constructed, but I'd say it was sort of a case study in everything that can go wrong in a property. It's in Houston, so the insurance went to $2,000 a unit. They had some problems, getting the construction done. Everything that can go wrong did go wrong. The taxes were reassessed at a really high rate. And so, it was sitting there, and the guys were on a variable rate loan, and it was a bad situation, and they had stopped putting money into it. And so it was at about 60% occupancy. And so we fortunately had, our investors well capitalized. So we bought it from them all cash. So we didn't have to get a loan. We bought it all cash, and, we got a very healthy discount to replacement cost on a brand new property that's 60% occupied. And we've owned it for 6 months or something, and it's, it's already well into the 80s occupancy, and we're, trending towards being in the 90s. And so that'll end up being a value add kind of deal, because we will increase the income a lot. We could probably go either put financing on it or just sell it. So that was a sort of a timely, distressed kind of deal. Everybody's always talking about distress, but we also bought, we bought a property last year that was built in the late 70s that had a value add component. They'd done half the units. It's in a market in Richmond, Virginia market that we have done a lot of deals in. But it had a value add proposition to it, but it also fit the affordability side of sort of what we call naturally occurring affordable housing. It's a nice property in a pretty good area, but the rents, it's not a tax credit property or anything, but the rents were sitting there at maybe, 60, 70% of AMI. So it sort of fit the mold of a naturally occurring affordable property and had a value add component. And so we were able to do that, deal like that. So, and now we're under contract now buying a new construction property that's just stabilized. It's just a nice property. It's pretty good. It's a 5.5 cap on a new construction property. It's just a solid deal, good basis. So we're trying to just find spots within the market of where something makes sense right now. There's not something like screaming like must buy property and redo all kitchens now. It's sort of like, here's a new construction deal. It's at a good basis. Here's a deal that's sort of is affordable and we can get it at a pretty good price, that kind of thing. So,
right. So you have your overlays, your filters, but then you're really kind of bottoms up looking at the opportunity level versus like, hey, I want to buy anything in Atlanta or I don't want to buy anything in Atlanta. I want to find a deal that's situational with a story versus, I'm focused on this market or that market.
Yeah, I tend to say when we go through the pipeline, like when the guys talk about it, I'm like, what's the play here? Is there a play here? It doesn't have to be like, we're crushing somebody and getting, the deal of the century is more like, okay, what's the play here? Is this is a basis play, or this is a affordable deal, or this is there's an opportunity here of some sort. And, and we find that all the investors that we work with, are, they're a little more cautious now than they were before, but they're still interested in doing deals and still, as long as it makes sense.
So I guess to that end, I think when we think about story tends to be the thing that gets people interested, right? It's not, of course you've got to clear the hurdles. The numbers have to be the right numbers, right? And you got to check those boxes. But if you can't tell a story that's compelling, then they can't tell a compelling story because everyone's just telling a compelling story to the next guy in the chain. Exactly. So, I think that goes a little bit into, it seems like you mostly work with institutional investors, larger check writers. Do you find that that's the way to get those folks interested, or could you maybe speak a little bit to how you develop those relationships over time? Was it, through performance, through individual deals, just time and attention, FaceTime? Like what does that look like over this 11 years now you've been working through this, this company?
Yeah, I'd say time is the key word. It takes a lot of time. Because most people that start a company like ours start, syndicating deals, right? They're friends and family, find a way to get one done and then get another one done. And some people build huge businesses doing that model. We come from, all of us here come from institutional backgrounds. We say we're sort of a small institutional firm. So we come from institutional backgrounds, and that was just kind of our mindset. And we're probably don't give ourselves enough credit, but we're sort of like, we're not totally comfortable calling, everybody we know and asking them for $50,000 for a deal. But we have a lot of relationships in the business. And so, obviously there's a relationship aspect of you have to know who to talk to. And then you have to be able to, so it's a couple step process. You have to know who to talk to. Then you have to present something that's, a value proposition for something that they would be interested in, which, is just what's your business plan? What's your experience? That kind of thing. And then there's just a time element of it. Just takes a long time. And, there's a whole, we have this fund, with it. It has 4 pension funds, and there's a pension fund advisor that's part of it. And we talked to them for 6 years, I think it was, before we started doing it, and not like every day, but, we'd have a meeting with them, and then they'd say, let us know how it's going. And then a couple months later, we'd call them back and I'd be, and then when we got to the point, like, what we found as a company was we were lucky. We started on third base because we had this relationship that gave us some money to start, and that was pension fund money. We got pension fund money to start, which was, it's pretty atypical in our space. And so that helped us. But so we got this money. We thought, hey, we got some money from this pension fund, and we'll just get, we'll spend that, and then we'll just go find some more pension funds, and we'll just keep getting money, and we'll be rich. Well, it turns out that, the one pension fund gave us money because they were trying to do deals with like a smaller entities as a sort of a special project or whatever. And, after we did a couple of deals with them, they're like, okay, we're done. You spent the money, and let's see how it goes now. You guys are a startup. Like, let's see how they go before we give you more. And so I would say, like, it turns out that most pension funds don't want to do deals with guys, 3 guys sitting in a room that have a couple of deals in Texas. It's like, you need to have shown like a track record and that's the hardest thing is you have to get going. And then it takes time generally for these things to marinate and then to be able to sell them and to get the track record. So then you can get more money. And so we got some institutional money. And then, after we had done a couple of deals, they sort of stopped and everybody else was like, let's see how it goes. And so, we wandered in the desert a little bit trying to find, some other people, which we did to do some more deals with us. And we found that once we did our first round trip, that's when, the road opened for us more. And then that's like when the guys I said we talked to for 6 years, when we were able to demonstrate to them like, hey, we did these deals, we sold them, we hit our numbers, we're legitimate. That's when the road opened. And so I think that's hard though. It's hard for a lot of people, especially if you're starting a business, because the one thing I always say is if you're starting a business, it's going to take a lot longer than you think it's going to take. Like, people are like, let's start a business, we'll buy some deals. And then in 2 years, I'll buy my first beach house. I was like, no, you won't. It's like, it's going to take a really long time. It just takes a long time. I mean, you can do it, but it just takes a long time.
It's 20-year overnight success, right? Right.
Exactly. Exactly. And so it's just, and so it's been gratifying for us, over the last couple of years, we've had a lot more. My partner Ken is always like, man, I can't believe when we started, we'd call somebody and say, hey, it's John, and be like, hello, nobody on the other end. And now people are calling us like, hey, you guys interested in doing some stuff? So the saying that I have now is when we started doing this, and for the first couple of years, it's like we had a lot of deals and we just didn't have any money. And it's like now we have money and it's hard to find deals. So hopefully we'll find the sweet spot where it all comes together, and that's
right. But you're set up. You've got all the resources you need when the market is more conducive to acquisitions. You guys can pounce on those, right?
I hope so.
Right. No, that's great. I guess a question, with the deals that you have, successfully exited, or the deals that you guys have done a bunch of deals, so you got pattern recognition on what works and what doesn't work. What do you think those things, the things are that are in your control as a sponsor that really affect change and drive returns at the asset level, right? I mean, you can't affect interest rates, you can't change, who's president, right? But you can do the things you can do. So what do you think if you were to pick a couple things that really drive performance at your level?
Yeah, there's probably, but I would say, 3 things just, off the top of my head, three things would be, the right strategy, right? So you go into it and, say it's a value add deal. I've seen a lot of people go into these deals and say, okay, we're going to renovate all the units. And they just go forth and renovate all the units. But sometimes, we had a property that we bought and that was our strategy. And after we did like 10 units, we saw that we were getting on our renewals, we were getting, a 10% rent increase. I'm like, could we just raise the rent 10% and not spend the money on doing the value add? Not that, as long as the thing's in good condition. And so it was like, we had a strategy, but we had to sort of, continually hone that strategy. And there were times when it didn't make sense to spend all that money, and we saved money. And our return obviously was higher because we didn't put out as much money. So having the right strategy and adapting the right strategy to the market, not just going, this is how I do it 1, 2, 3, but being flexible. And we always tell people like, the model says this, but once we get into it, it may be a little different. We may find that we don't need to change the refrigerators, but we'll model it out, but we may not need to do that. So I think that's super important. I think the management side, and we don't have a management company, we use third-party management. And the management company is really big because they're the boots on the ground. And, if they're not the right one, and people sometimes say, why don't you have a management company? And it's a bit of a headache, but also we own a tax credit property in Virginia, and we own a brand new Class A new construction property in Dallas. The management, most management companies aren't good at both of those. So we find the right management company that should have the right experience in the right market, and with the right product type. And that's huge. And it doesn't always work out. I would say we're not the team that's going to fire the coach after one losing season, but we're also not going to give him a lifetime contract. So we have changed management companies, and that's really important because you can, that's a people business. And if you have the right people, it's great. And if you don't, it's not. But the management side of it is going to make you money. And then the financing side is really important. Obviously, as you said, we can't change interest rates, and that can't affect, what the Fed's going to do or any of that stuff. But you can structure the deal in a way that's going to make you money. I'll give you an example of where this hurt us. Was we had a partner who was, they were good. They were nice guys. We liked them, but we were buying this property as a value add property. and we said to them, this is a time, this is kind of a short-term thing. So let's either buy down the prepayment, or let's do a variable rate loan where it has like a 1% prepayment penalty, and we can get out of it, because we're probably going to want to get out of this in like 3 years. And this was in 2017, I think. And they said, no, rates are low now. And, which they, by the standards of 2 years from then, they were not low, but they're like, rates are low now. If we have a long-term fixed rate loan, we could sell it as an assumption. It's an asset for the property. So let's not only get a 10-year loan, let's get a 12-year loan. And we were like, I was like, we told you we thought our value add was the financing. We think you should do this, but I would say the golden rule, they had, they put up most of the money, so they get to decide. So we did a long-term loan, and then, 3 years later, we all decided it's time to sell it. And we went out to sell it, and, we did well because I said cap rate compression. It didn't matter what we did. We did well on the deal, but we would have made collectively a couple $1 million more if we had done the other loan structure. And us on our promote, we would have gotten, like multiples on our promote if we had done the structure that we had done. So those three places are probably, the places where I've seen the most impact.
Yeah. So flexibility around strategy, having the right people on the ground, which is through the management company, and then having the right capital structure and the financing strategy, right? Yeah. There was a lot of people, it was gut wrenching a little bit, I think, for a lot of folks to pay 10, 15 points in yield maintenance to sell, hey, they're still getting a 3-4 times multiple, and that's on their equity. That's great. But oh my gosh, a 7-figure prepayment penalty just going, to buy treasuries. It's a rough to stomach thing, but we all, I think we all, fell into that situation, right? It's like, hey, I can lock in 4% yield in 2017, 18 on a 6% going in cap. Why wouldn't I do that?
Right. Of course. Right. And this is all right. And this is all in retrospect, right?
Right.
Yeah,
Yes.
Sorry. Hindsight's 2020. Right.
Absolutely. So. I just wish you could get into the future, and so you could see that hindsight, in advance. Right. But then I guess it wouldn't be hindsight then at that point. As we're winding down here and we're running out of time, and I appreciate all the time you've given us today, obviously a lot of changes happening in the industry, technology, and other things. How do you, as a professional in the industry for a long time here, stay up to date on trends, whether that's like certain news, sources or conferences, someone who's coming into the industry today, what would you recommend for them to stay up to speed, as it relates to what's going on in multifamily?
Yeah, I think it's so much easier now than it was back in the day to stay up to date on things. There's so much more information available. What I do, obviously I talk to people during the day, and I know a lot of people, and I do speak at a bunch of conferences and stuff. But even if you don't do that, every morning I have my couple of email newsletters that I read. The Biz Now, and there's like CRE Daily. There's a whole bunch of them, and you can subscribe to those things, and you can read them, and you can read it every morning. You can skim it or whatever, and sometimes it's repetitive because not that much happens, but you can stay on top of things so easily now. I feel like just spending like 15 minutes a day, 10 minutes a day, just reading. You hear about what deals are going on, and it might take a little time to figure out which places give you the information you're looking for, but there are so many sources of information, most of them free, and you can stay on top of what's going on in the market super easy now, and there's so much more information than there used to be. I'm old enough to remember when when somebody was selling a deal, the brokers would just call you. There was no blast emails and any of that stuff. So the technology has really helped, and our industry is probably one of the worst of industries in terms of adapting to technology. But technology has helped so much in terms of information flow, staying on top of things, and so anybody knowing what it is. I teach a class at Georgetown Business School, real estate finance, and the students there, they know so much more about the industry. They're interested in real estate, and they just, I'm like, hey, just read this. And they all know, they ask questions, oh, did you hear about this deal, that deal? It's like, God, when I was your age, I would have known any of that.
Yeah. So, right. So. Yeah. No, that's great. Do you have not that I want you to play favorites. Do you have a favorite conference, perhaps that it's your go-to every year or whatnot?
NMHC is the one that I think we all
Yes.
go to. I don't know, maybe indoor is the wrong word. We all go.
I'll see you in
spend 3
January
days.
in Vegas. Yeah.
Exactly. We all spend 3 days going from meeting to meeting to meeting. But that's I think that's the biggest one of the year. There's lots of other ones around and they're great, but that's one where everybody goes.
Yeah. Yeah, that's a good one.
And you can meet the most people. And also, I don't know about the content because I rarely ever go to the meetings because you're usually out in the hallway meeting with people.
It's a great agenda. It's hard to get from. It's hard to do the agenda and the meetings at the same time. Yeah. I think it's a great place to be able to get like 30 meetings done. Everyone who's doing deals is all there. So Well, Jon, thank you so much for the time today. I think this was really helpful. Really enjoyed getting to know you, how you developed through your career, and I'd love to just offer if you if listeners wanted to get in touch with you for one way or the other, to the extent that you'd like that to happen. Do you have what's the best way for people to contact you? Would you say?
Yeah, probably. I mean, you go. I'm on LinkedIn. Yeah, it's Jon Siegel. So most people spell my name wrong. On LinkedIn, or you can send me an email, which is jsiegel@railfieldrealty.com. Just shoot me an email. I'm pretty big on getting back to people. So if somebody call, I always try to call everybody back or email back or whatever. So
thank you so much, Jon. I appreciate your time. It was a pleasure, and you enjoy the rest of your week. Go find some more deals to buy. That investment strategy.
All right. Well, I appreciate it. Yeah. Thanks for having me.
Thanks everyone for listening. And I look forward to you guys all joining next time on the Deal Flow podcast.